SD Bullion has just launched Survival Food, headlined by the only 100% organic, GMO-free survival food. Prepare like the doc. Purchase your survival food from SD Bullion today.
The Silver Bullet Silver Shield proudly introduces the new 2-ounce Freedom Girl. She's bigger, bolder, and beautiful, and available at sdbullion.com.
SD Bullion.
Metals and Markets is sponsored by DNA Precious Metals, a near-term producer of the Montauban tailings mine in Quebec, Canada. DNA Precious Metals trades on the OTC BB market under the symbol DNAP.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Report. Quite an exciting week this week, Eric, with all the last second drama with the debt ceiling debate. Finally, as expected, the Republicans did cave, and it's being reported as kicked the can down the road for several months, setting up another discussion in January, February, March timeframe. Probably really would be about April before all the extraordinary measures would be exceeded again. And not too surprisingly, gold and silver had a pretty decent week in the aftermath of that. Gold up about $50 from last Friday's close at $12.67. We had a close today here just under $13.20 in gold. And silver up nearly $1 on the week from $21.25 to a close just around $22 today, just a couple of cents under with the close today here. So a pretty decent recovery for both gold and silver in the aftermath of the debt ceiling being raised on the late hours Wednesday into Thursday, Eric.
Yeah, and to paint the picture of how the cartel acts, one general rule of thumb that's been consistent for over a decade is that whenever there is a crisis, the powers that be don't really want people to look at gold as a safe haven, and silver as well. And what they do is they come in and pressure exactly counterintuitive to what the laws of economics would suggest in terms of people looking for an asset that's outside of the banking system and more immune to currency risk, debt risk, etc. And that's exactly what we saw this week play out, or in fact this whole month play out in this whole 14-plus day debate. And kabuki theater underwent in the media. And if you look at the swings of gold and silver, it's only when everything is resolved and everybody feels, we have a can-kicking session ahead of us, that gold and silver are given a little bit of a reprieve and they rise. And, that isn't just something that I throw out as idle speculation. There's actually data points that you can look to that suggest that this is, in fact, an active manipulation going on. Doc and I were talking about something off air that we're going to outline here. In terms of the GOFO rate, it's interesting to note that it is now moving negative, whereas during this whole crisis it was positive. And if in a counterintuitive type of way, if you consider what that would suggest is going on in terms of official gold supply, perhaps being sourced from central banks leasing their gold out into the market to calm prices down or even push them down really hard, as a mechanics translation in terms of what would happen on the London bullion market, you can see that the higher increase in requests to take gold off of that market being met by official sources of gold can in fact result in the GOFO rate being somewhat normalized, showing a positive interest rate of GOFO. And when it swung back into the negative in the last 2 days, we see the price of gold going up, which suggests that the central banks supplying gold, presumably, we can't prove it, but that's what the data shows, they have stopped supplying gold for the time being because, quote-unquote, the crisis is over. So when you match that up with what we see in terms of the huge bombing raids in paper gold markets, we'll provide a chart with that in our write-up this week as well, too, and we strongly recommend you take a look at it. I mean, it speaks for itself. We spoke about this last Friday when there was the equivalent of 2 million ounces being bombed within a very short period of time, and it's getting so apparent that even sources like Reuters can't turn their back on it. They have to report these kind of things because the traders in the pits are saying, hey, what's going on here? I mean, it's an open secret now that there's increasing use of what amounts to flash trading in the gold pits, and the suppression that's happening is so apparent that even mainstream media is beginning to connect the dots and report on it. So it's just yet again another example of how these markets are managed, along with the bond market overtly, and the press is free to speak about that because that's official policy. But even in the gold market, it's a sad state of affairs. We don't have a transparent and free and open market in gold and silver. And this week speaks volumes. You can see it in the data.
And we've seen that for those who have followed the gold and silver market throughout the last 10 or 15 years, we've seen instances of that repeatedly, where during big crises times, particularly gold is smashed and painted to be perceived as anything other than a safe haven. The main goal being to prevent the public from viewing gold as a safe haven from the ongoing crisis. I think back to, I think it was November of 2011 when the Swiss franc was pegged to the euro, and literally 5 minutes before that announcement, gold was hit with a few $1 million sell order and was smashed by, I think, over $50 in just a few minutes prior to that announcement, pegging the franc to the euro, which normally would have had pretty bullish implications for gold. I can think of a few other instances throughout the monetary crisis where with the announcements of several of the big four-letter acronym systems put in place by the Fed and the ECB, that gold was hammered on the news and for the next week or two afterwards. So really, with the budget crisis here and what we saw in last week's big 2 million ounce paper dump is really just a continuation of that, Eric.
Another example, too, is the lead up to the possible action of military strikes in Syria. A couple days before, and then certainly through the period of September, the price of gold was massively suppressed. So, thou shalt not look at gold as a safe haven. Treasuries, remember, treasuries, because those support the dollar and the United States economy, and keeping also the banks solvent, because if the price of interest rates shot up as bonds fell down, the banking system would come under another crisis. And that's exactly why when interest rates on a 10-year hit exactly 3%, the Federal Reserve switched with its tapering BS, and the entire stepped-up activity of suppressing gold happened from that point forward. I mean, you can match the prices with these policy shifts and build a timeline of the chronology of what happens in terms of the significant political events and see these exact correlations. I mean, it's above 90% correlation. It's just astounding to see this stuff. So, then when you match it up with the actual paper bombings that we can see, all of the data pretty much supports the thesis that this is not conspiracy theory, it's conspiracy fact. But
And we saw the same thing happen really after the last debt ceiling solution in 2011. I want to say that gold was up 17%, I think it was, just in the few weeks after the agreement, when the crisis is over, if you will, or kicked down the can until 2013. So just like Eric was pointing out regarding the GOFO rates plunging negative again as a sign that the cartel has perhaps stopped supplying bullion into the market. Really saw the same thing back in 2011 as we've seen so far, with gold rising about $40 or $50 here since the Wednesday night with the crisis ending.
Right. And the other major piece that we haven't spoken about yet is that the premiums that are in India and China suggest that, in fact, we were replaying the cycle in the May, June, July period where prices had fallen to the point where it elicited enough physical demand in the Asian markets such that in India we now have been seeing 8% premium reporting over and above the excessive taxes and all the other restrictions that India's government has been putting in place. And that's pretty significant. So the timing of that, in fact, matches exactly with the limitations that the cartel has in terms of monkeying around with paper, because as they push paper prices lower, the physical demand offtake begins to rise pretty significantly in Asia, and there's only so much gold that they can push through the LBMA market in particular, that being more of a physical market, and at least to some extent, because the PM fix does set the price for physical deliveries out of their inventories, and traditionally it's more of a physical market than the comics. So these these monkeys who are pushing the price around only have so much wiggle room to go before it begins to backfire on them. And when we saw and reported last Friday in the radio show that the premium went to $8 above spot in India and $16 above spot in China, and continued to see that same level of premiums this week, it's no surprise that the cartel backed off once the political justifications for making the dollar the safe haven versus the gold kind of evaporated by Wednesday, when this whole budget and debt ceiling crisis, quote unquote, was resolved. So all these pieces fit perfectly together, folks, and it doesn't take a rocket science.
Especially when you consider it in light of the fact of China's statements this week. Earlier in the week, China's official press agency came out and ran an op-ed article calling for the de-Americanization of the world.
Right.
And if anything, they're with this whole crisis and fiasco with the U.S. debt, certainly China and the other creditor nations are going to look to step up or accelerate their diversification out of dollars and into gold and other currencies away from the dollar, as China's no longer just doing this quietly under the table. They're now openly calling for it with that article, I think that ran last Sunday, which is really a pretty big shift to go from quietly converting as many assets without calling attention to it or shifting the scales, or if you would, but to now openly, publicly calling for a global move away from the dollar.
And on a geopolitical front, early last week we had, or I believe it was early last weekend, if memory serves correctly, we had the APEC summit, and Obama initially was scheduled to be there, and he didn't show up, and John Kerry stood in his place, and the official photo of the event had John Kerry way in the far right corner of the assembled leaders of the APEC community, which is symbolically representative of where things are. I mean, the United States is losing its power geopolitically, and all of this craziness when it comes to how we're managing our economy, or lack of managing it is probably a better way of saying it.
And a lot of Americans may not realize the significance of that. That's just a picture, and it's not Obama, so what does it really mean? But for Asia, that's pretty significant symbolically.
Well, even the United States does those diplomatic rubs when snub operations from a symbolic point of view. I can remember back, I believe it was... I think it was 2004 when the premier of China had come over to visit President George W. Bush, and Bush had played the Taiwanese national anthem in the opening ceremony welcoming the premier of China, just to snipe, just as a political statement. And then the next visit that the premier came to the United States, instead of visiting the White House first and foremost, the plane stopped in Seattle, and the premier visited the chairman of Boeing and Bill Gates and spent the day in Washington, as in Washington State, as opposed to Washington, D.C., before blessing the president with his presence. So these kind of games happen all the time in international relations, and they're kind of comical to watch, but they do in fact signal geostrategic shifts, and they're pretty telling.
One story I want to cover here that has largely been overlooked this week with all of the 24/7 news cycle with the debt ceiling was an IMF proposal that's been discovered, that the IMF basically is considering or proposing a one-off wealth tax across the EU of a 10% wealth tax. So this is essentially a 10% bail-in of all wealth, a government bail-in. And I just want to read a couple of the paragraphs here of the IMF's proposal. And the paragraph reads here: the sharp deterioration of the public finances in many countries has revived interest in a capital levy, a one-off tax on private wealth, as an exceptional measure to restore debt sustainability. The appeal is that such a tax, if it is implemented before avoidance is possible, and there is a belief that it will never be repeated, does not distort behavior, and may be seen by some as being fair. So
keyword being if.
If there's a belief it will never ever be repeated. So essentially they're saying if we can steal 10% from everyone and they think we're only going to do it once, we'll be able to get away with it.
Yeah, don't worry. We'll just cut off everyone's left hand. You still have a right hand. It's only going to happen once. We aren't going to go after the right hand.
And I'm getting a little bit ahead here on the 10%. It goes on to say the tax rates needed to bring down public debt to pre-crisis levels, moreover, are sizable. Reducing debt ratios to end 2007 levels would require, for a sample of 15 euro area countries, a tax rate of about 10% on households with positive net wealth. So they're discussing here the possibility of a 10% wealth tax across the European Union. Now they go on to say that they recognize that such a bail-in would come with risks. They say the conditions for success are strong, but but also need to be weighed against the risks of the alternatives, which include repudiating public debt, or inflating it away. These, in turn, are a particular form of wealth tax on bondholders that also falls on non-residents. So they point out it's possible we could still continue quantitative easing and inflation and inflate it away and steal from bondholders and non-residents and do the wealth tax that way. But also we might be okay just doing a one-off 10% theft wealth tax if we can convince everybody that's just going to be once, and we do it before any avoidance is possible. So before the news leaks and before anybody does anything to protect their wealth, if we just swoop in and steal 10% of it, this might work.
Yeah, and the important thing to point out to folks is that obviously the IMF has no direct power over the European Union, but what this suggests is the way policymakers are beginning to look at the situation in terms of countries and their national debt and the EU debt overall, and the difference here versus what was going on with the Cyprus bail-in scenarios, etc., is that those dealt with the collapse of systemically important institutions and how to deal with bailing out those organizations, whereas what the IMF is talking about now is more of the structural problems of just excessive debt, generically speaking, at the sovereign level, the nation state. And that's a pretty significant change in that they're talking about wealth taxes. It's analogous to how we continue to hear stories about in the United States of trial balloons about the federal government taking over pension systems and forcing people to put their assets into U.S. treasuries because it's safe and the government wants to protect you. But in reality, what it's all about is that there's about $17 trillion in retirement funds sitting out there in the United States that happens to, pretty closely match where the national debt is, at least the cooked booked numbers and non-traditional financial accounting numbers, and how that comes to some, just shy of $17 trillion. So, Washington's beginning to salivate over that big pie, and it's analogous to what this IMF policymaker wet dream is when they're putting this out there as a trial balloon for the folks in the ECB to think about. So all in all, if you got money, government wants it.
Right. So this is just a proposal by the IMF at this point. By no means is it like Cyprus, where it's going to go down this weekend or anything, but it's just one more thing showing the handwriting on the wall that if you're not out of the system, you better start to think about moving your assets out of the financial system. As Jim Sinclair would say, get out of the system now.
I mean, you could think about the 1%ers and beyond, or the 0.01 percenters, probably better said, in Europe, reading things like this or having their financial advisors speak to them about how, hey, those bureaucrats over in the IMF are recommending the ECB and the national governments to do this one-time wealth tax. And don't worry, it's only one time, it won't hurt you. But, by the way, maybe you should up your supply of rare Rothschild's wines and fine art and gold and all that stuff that you can put in your basement and nobody in a bureaucratic office can count as wealth, so they don't take 10% of it. I mean, that's the way these things go down.
Exactly. And really along those lines as well, as far as reading the handwriting on the wall, the other big news this week was JP Morgan Chase announcing, in effect, their own private bank capital controls that they sent letters to all of their business account holders this week. All the business owners received the letters this week anyways, midweek, that all of their business accounts as of November 17th or no longer. JP Morgan will not process any outgoing international wires. If the money's coming into the U.S., those wires will still work, but no funds going out. And also they're going to limit all cash transactions per month to $50,000 for your account, which the average listener for their personal account, that probably seems like no big deal. That's an enormous amount, but we're talking about business accounts here that if you think about any business that deals in cash, whether that's a grocery store, a restaurant, any significant cash, and it's...
Or even, clients that are involved with the manufacture of goods and services in the United States. I mean, if they're importing components, you can easily get a $50,000 bill for a bunch of motors that you're including into a physical product, or circuit boards that are being integrated into tablets or what have you that may be manufactured in Austin or Texas somewhere or so forth. It's
right. Supplier bills are probably going to be 95% are going to be handled electronically through the banking system, and not going to be as much cash deposits as would be like a retail business. But any retail business, whether that's a clothing store, whether that's a grocery store, a coffee shop, they deal in cash, and it's $50,000 of all transactions, whether that's withdrawals, deposits. So they're moving to limit the movement of cash, money that's not traceable or trackable where it came from, and also movement of cash out of the U.S. So no problem if it comes in. We don't care if it comes in, but we don't want you to be able to move it out of the U.S. So there's been some rumors that J.P. Morgan was... and Jamie Dimon was pressured by the government in their private meeting a couple weeks ago. I think that's just speculation at this point. I've heard a couple of people say that they've talked to sources who have stated that's the case, but at this point I think we can only say that's speculation. But regardless, whether it's a JP Morgan internal decision, which really doesn't make any sense from a business standpoint because they're just asking business customers to leave. We would never bank with JP Morgan, but if we did, with SD Bullion, we'd have shut our account that same day and found someone else who wouldn't do that. So it doesn't make much sense from Chase's standpoint as a business, because you're driving any of those customers affected away. That anybody who has to deal in cash, they're not going to stop taking cash from customers because you won't. You're going to start charging them big penalties for each dollar over $50,000. They're going to find another bank, if there is an alternative, that'll handle their business. So, as well as anyone who needs to transact with suppliers. But yeah, as far as what Eric was stating about the suppliers, there's all kinds of international suppliers, and $50,000 wiring out of the U.S. is nothing. Any even mid-sized company is going to do that in hours. So
right. And as we go through the process of continually moving more and more concentrated as a financially centered economy, both in the United States and just the Western economies overall, financialization ends up representing more and more as a percentage of the profits of these companies like JP Morgan, such that the real world banking requirements of an economy where physical goods are being manufactured and you need short-term credit to finance those operations become a smaller percentage of the overall banking system pie, such that they don't really care when it comes to what JP Morgan thinks and Jamie Dimon. If they are, compared to where they were 20 years ago, the derivatives markets gains that they are able to make, particularly when they have the happy hand of the U.S. government helping them know what's going to be public policy, ends up creating monstrous piles of profit vis-a-vis what they do in the normal banking world. So, the whole system is just skewed to the point where the normal price signals that come from what are supposed to be the invisible hand of Adam Smith guiding economics are completely bastardized. And it's not just, you would expect the banking community to be up in arms and saying, hey, what do you mean we can't do these kind of things? Why are you doing these regulations? It's going to hurt business. But ultimately, they don't. These operations are less and less of a percentage of their ongoing business. I think that explains partly why they're willing to, acquiesce to the capital control restrictions, and we will continue to see that trend going forward, because basically we have an unstable financial system that is continuing to get worse simply because no one in power wants to act like an adult. They just want to keep papering over the problems with more and more debt an ever greater concentration of the financialization process of the economics of the world. And on that happy note...
Yeah, on that happy note, the moral of the story, or sum things up, read the handwriting on the wall and follow Jim Sinclair's advice and start getting out of the system now if you haven't already.
Yeah, there's that. And, there's also the one caveat that we can say is that, it may not be wise, and in my opinion it is not wise to put 100% of one's assets in the gold and silver, but you find out whatever that level is that allows you to sleep at night and get it out of the system. Have it as physical in your possession, or a balance of if you have a huge amount of or a large amount of assets that you need to deal with. Sometimes it's best to do a little bit of high quality mining equity shares that you have in your physical possession, or at least out of street name, quote unquote, and physical gold and silver, and oil companies, maybe even farmland if you can own that, and timber.
Right. So other physical assets as well to diversify yourself with.
I mean, generally speaking, the powers that be are not out to make war against oil companies, for example. So if you were just plopped down in 100 shares of Exxon for a typical family, that's a pretty significant chunk of typical net worth, and it pays a decent dividend, and you have a little bit more diversification above and beyond what gold and silver can provide. So I'm not necessarily saying anything that's relevant as investment advice for every person out there, because everybody's situation is different. But try to think in terms of the diversification, folks, because that's the message that quite frankly, most bullion dealers would not be telling you. They want you to just go buy gold, silver, 100%. But when we look at this scenario and where we are going forward, you really just have to be careful, because we certainly SD Bullion would love to help service all of your needs when it comes to bullion, but at the same time we have to be honest, give as best of an assessment of where we can see the future, and the bottom line is that nobody has an absolute vision of what's going to happen in the future.
Right, exactly. All right, so we'll keep an eye on the GOFO rates. Gold has moved up this week as the rates plunged back negative, indicating supply stress and strain again. So we'll keep our eyes on that over the next week and see if gold and silver can sustain what perhaps is the early stages of a rally here. So for the Doc and Eric Dubin, thanks for tuning in to the SD Weekly Metals and Markets.
SD Bullion.